The Neil Haley Show and the Lion Share podcast with our host, Ed Lyon. Ed, again, you have another amazing guest. I look forward to learning about him. Who do we have today?
So, Jinhong, I want you to go ahead and introduce yourself so that I make sure everybody gets your name correct. Jinhong has been a member of my Taxmaster Network community for years. He is yet another CPA who has escaped from the compliance prison and moved into the planning world. And we're going to explore a little bit more about that in the rest of the podcast. Jinhong, if you want to tell us a little bit about yourself and your background and how it's a little different from the traditional CPA.
Yeah, definitely. First of all, I started my career as an auditor.
Okay. That's miserable.
Yeah. And I was, just being kind. I was helping nonprofits, and one nonprofit I helped them, and they're a startup, so that cross the T and dot the I. So eventually, it's a husband-wife team, and then they divorced, and then they claim that wife basically says, "Hey, you didn't find the embezzlement from the husband." And I said, "What? I helped you guys." And I'm like, "You guys, of course, you guys don't even have book, How can I
Right.
say you have to sign everything, all of these?" So I said, "Okay, this is was miserable." And then I remember that many years ago, somebody told me about the Ed Lyon tax coach. And so I said, okay, maybe I should go do tax, right?
Mm-hmm.
And it's I wasn't confident about tax because in college, I was learning tax and it all fragmented. It's all this is income, this is deduction, this is a depreciation. I was lost.
Mm-hmm.
When I read your tax architecture, I think, I just print it out and I read it. It's wow, this is so simple. The entire learning tax is about saving tax, and there are only 3 strategies. And I'm I got it.
Right. Well, thank you. That's very flattering. Yeah, that's been a key to my own success and to the tax professionals who I've trained. It's making the tax system simple enough that you can explain it. Maybe not necessarily to a kindergartner, but to a bright, educated adult who's running a business or earning an income or raising a family or looking to cement a legacy. And I think the tax work we do is more meaningful than the audit work. Tell me a little bit about auditing. That just, to me, that makes my skin crawl.
I think the auditing is just a game. It's some academic person many years ago saying, we can do this audit, and then now it's a game everybody play, right?
Mm-hmm.
The reality is that you pay me to audit to you, right? There's an inherent conflict of interest.
There's an inherent conflict of interest because if you're running a business for a profit, you want the revenue to keep coming in.
Yeah, it's really, I feel it's just a rubber stamp, and it's just a game. And then all these procedures I have to check off. It's just so tedious. What's the point of getting the bank statement and check, tracing the bank statement to the book balance? Nowadays, everything is all connected. For my clients, everybody has QuickBook Online, and I have the QuickBook Online is instantly updating the bank account. What's the point of checking that again, right? It's you are reconciling every month. Why do you need to even send a confirmation letter to the bank and ask the bank to say, okay, this is the balance? How stupid is that?
Well, so years ago, a philosopher named David Graeber wrote a book called Bullshit Jobs. Mm-hmm. And a bullshit job, you're familiar with this, Neil?
No, I'm not. I can't wait to hear.
So a bullshit job is one where everybody involved knows that it's bullshit. It's basically a job that society could do without. And a lot of checking boxes are bullshit.
Yeah.
So if you're auditing, you are, as Jinhong is saying, you're verifying things that really don't need to be verified. So are you contributing any value to a business relationship, to a client, so that the client can say, oh, I've been audited? The client saying I've been audited means they're going to a bank or they're going to a prospective acquirer or business partner and saying that somebody with the letters CPA after their name and a big malpractice insurance policy looked at my books to verify things that are obvious are true. Now, there is more to it in some cases, but I think you put it well when you said it's a rubber stamp. It's a rubber stamp at this point because the technology does a lot of work of the auditing, and the big four accounting firms have been working for years with machine learning and now artificial intelligence to find ways so that the books essentially audit themselves.
Yeah.
Within a couple of days of the end of the month. And the big four would love to be able to cut their auditing staff down to maybe 3 or 4% of what it is now, because you have desk after desk of Bob Cratchit type clerks sitting in a cubicle recording something that's already been recorded. And for most businesses, that creates little value. It's supposed to protect investors so that if you own a publicly traded company, if you own stock, you know that somebody is auditing the company so that you can trust the financials. And let's be honest, there are companies that will present fraudulent financials. They're usually easier to discover than you think. And what it does is it emphasizes how much of the world runs on trust. So there was a guy in New York City who was a really famous money manager. He got his start creating something called payment for order flow on the NASDAQ. And he would invest money for private clients. And they would come to him and they'd say, we'd like you to invest our money. And he'd say, I'm probably not right for you. He would push them away. They'd really want to give him their money and he would invest the money. Do you guys know who I'm talking about?
No.
Jinhong, you know who I'm talking about. Bernie Madoff. Bernie Madoff.
Oh, yes.
And people trusted that the money was being invested. There were whistleblowers years before 2000, and I think it was 2008 or 2009 when he was finally exposed as a Ponzi scheme. But there are people who had gone to the SEC and said, look, this is a Ponzi scheme, but nobody audited him. And probably a third-year accounting student would have been able to go in and expose the fraud. So that's important on a particular level, but short of exposing fraud and malfeasance, ordinary auditing is not a particularly high-value activity. Now, the auditors will say that's exactly what we're doing. We're insurance against those frauds. We're insurance against that malfeasance. But where's the fun in that? With tax planning, I'm sitting down with the owner of the business. I'm taking the numbers that their accountant has put into their books, and I'm not just looking at, are these numbers correct? Are these the real numbers? I'm looking at what can I do with the numbers so that the client ends up in a better position. They pay less tax. They have more money to reinvest in the business or hire new employees or send their kids to college or trade school or buy a vacation house, which provides jobs for the people in the vacation home industry. It's a lot more fun. Audit is this true? Verify if this is true. Whereas tax planning is a puzzle. It's not a game. It's a puzzle.
Yeah. And I totally agree with you. It's for me, just meeting you and learning from you, it really changed my life. Not only, the joy of doing the work, but also meaning of life. For me, I always believe in entrepreneurs and love entrepreneurs. I believe, they are the most productive people in our society. In fact, I believe they are the only real adult who hunt for themselves, for their family, and for our society, for their community.
Well, they're the foundation of our economy.
Yeah.
They're the foundation of our capitalist economy, and I'm helping them keep more of the fruit of their labors. They do lots of different things with the fruit of those labors. Some of them are very generous with charities. Some of them buy a collection of 13 cars. Yeah. And if you are if you're an opponent of the oligarchy and you're opposed to wealth, you can absolutely criticize that. But like it or not, capitalism is the greatest job creation engine that the world has ever seen, and capitalism has lifted more people out of poverty than any other system in the world. So I'm happy to be a part of it. And those of you listening to this podcast, welcome to capitalism. We're glad you're here.
Yeah, I love, in America, we have all these policies. And I would always talk, when I was talking on seminars about American tax laws, right? The tax laws, American tax laws are amazing. For example, the qualified small business stock, section 2. $15 million capital gain. No capital gain tax. It's like, where do you do that in the world? And I always call America is the Republic of Entrepreneurs. If you look at the tax laws, it's like really, really very friendly to entrepreneurs. And that's the intention.
It's friendly to entrepreneurs. It's friendly to business. And most successful countries are set up that way. People look at Scandinavian countries and they think, oh, those are socialist countries. Well, Sweden's not a socialist country. Sweden actually has twice as many billionaires per capita as the United States. That's an astonishing fact to a lot of people. Sweden is a capitalist country that has very robust social safety net and guardrails on their capitalism, but it is a capitalist country. Norway is the biggest, I believe they have got the biggest sovereign wealth fund in the world. Norway is a capitalist country. They export oil. They're a big player in energy markets internationally, but it is all built around capitalism. Their capitalism looks different from our capitalism. And I have people who know Sweden and who say, I wouldn't want to open a business in Sweden. Well, I know people who wouldn't want to open a business in California either, because there are more regulations. But you know what? More wealth is being created in California than in any other state. That's the home of Silicon Valley. Jinhong, you were in California. Are you still there?
Yeah, I bought a vacation house in St. George, Utah. And so I'm traveling between California and Utah. And, my previous base is in Los Angeles, but also I have other clients in the Silicon Valley. So I travel between Silicon Valley, Los Angeles, and
right. So here you are singing the praises of capitalism and the power of being an entrepreneur, and you're doing it from the state with the least friendly climate to new businesses in the country.
Yeah. I have to ask a question: how he does it?
Yeah. So tell us how often are you running into new people? You talk about the qualified small business stock. Exclude $15 million of capital gains from your taxable income. There's more of that going on in California than there is anywhere else.
Yeah, I mean, I love Silicon Valley. Every time I go there, it's like everybody has at least one PPT pitch deck, right?
Oh, sure. You're not allowed to live in Silicon Valley if you don't have a business.
They're always inviting me to all these pitch deck, all these road shows, and it happens in restaurants, in somebody's home.
I need to hang out with him. I need to go to Silicon with him. I can be a bodyguard. And then say, hey,
everywhere. So it's like it's amazing the energy there. People are always excited and have a great outlook for the future, and I love that. And if you listen to them, like they're all at the cutting edge of technology.
That's the one thing I like about that, Ed, is their whole biohacking thought process, health conscience.
They're not just at the forefront of technology, but they're at the forefront of society. Yeah. And that's a good thing. So, for example, you have Palantir saying traditional college isn't serving Americans well, and they'll set up a program where really smart high school seniors can come in and get some post-secondary education, but start into the world of work. Now, you may think that college is a luxury now. You may think it's not a necessity. But what's happening is Palantir isn't just building a company. They're experimenting with a new way of moving people from school into work. And a lot of that, you mentioned the biohacking, a lot of the health stuff, that's happening in conjunction with the growth of the economy and the growth of the entrepreneurs there. And you think, oh, California is the worst state in the country for capitalism. Well, it's harder to start and run a business there. It is hard to fire an employee in California. There are a lot of things that are harder to do in California than anywhere else. But if you're a bright, hungry, ambitious entrepreneur and you're 28 or 30 years old and you want to be a part of the tech scene, you don't want to go to Des Moines, Iowa, or Lincoln, Nebraska, or probably not Cincinnati, Ohio, where I am. If you want to be surrounded by a community of endless energy and enthusiasm, California is the place you ought to go.
What I love most is the ecosystem there, right? You have the VCs. They are very open to risk. I have a VC client. You raise a $5 million and you invest in 10 startup companies, and first year one dad, second year another dad, third year another dad, and fourth year another dad, and then fifth year you have a unicorn.
Right. You just need one unicorn.
Yeah.
And one unicorn is all it takes. So the venture capitalists, I'm not sure they would say that they are embracing risk so much as they are managing risk. They're spreading it around. So $5 million doesn't go into one startup. $5 million goes into 10 startups. And maybe two of them are healthcare, and one's a pharmaceutical, and one of them is AI, and one of them involves some kind of international business. What they're really doing, they're like an insurance company. They are spreading the risk around. They are raising the odds that they'll have a positive outcome. And if they end up making more than putting money in an index fund after their fees, they've earned their keep, and they've become very, very wealthy and influential. You have people, entrepreneurs in California who, some of them think that if they can make $1 billion, they can run society better than we can. I don't necessarily agree with that, but it's where the energy is. So, Jinhong, you mentioned the Section 1202 qualified small business stock. That is one strategy that you use with clients. Tell me a little bit about the approach that you take when you're sitting down with a new client, a business owner, or someone who's opened up a new healthcare practice or something like that, whether they're in California or Nevada or Utah. And I know you have clients across the country, but what is your approach for helping them manage that energy and minimize interference from the IRS? Do you have a tax planning philosophy, a system? Let's hear about that.
Yeah, I have a lot of philosophies, and most of it I learned from you, and then I kind of added my own little twist, right? So
I hope you add your own little twists. So
I have a lot of things that I could talk about. How much time do we have?
We've got another 20 minutes, 30 minutes.
Yeah.
Okay. I'll be brief. First of all, let's since we're talking about the 1202, right, section, clients approach to me, say, hey, how should I start an S-Corp? Should I start a C-Corp? Well, I ask, what kind of business are you in? Well, it's a technology company. Okay, great. That sounds awesome. And you have an ability to scale quickly. Yeah, once the technology is feasible, can be adapted worldwide and through the internet. That's awesome. But I talked to my lawyer and accountant, and they said you should start an S-Corp because C-Corp has double tax. I said, well, you're missing something big. You want to save something more, but you're missing something big. There's something called a qualified small business stock, which allow you to have each investor have 50 million, the greater 50 million.
And if or 10 times your basis. And if you're one of those investors and the stock really pops and you've got $100 million worth, you can give your kids $15 million each. And you can set up a trust for the benefit of your in-laws for $15 million each and your grandchildren. It's a pretty porous limit, that $15 million.
Yes. So I say, it's like if you are looking at this S-Corp, so-called avoid double tax, first of all, if you have a technology, your money is not made through distribution of your profit. You want to, like Amazon, use your profit to develop business and create value for your company. And eventually, the money you make is from the capital gain. And capital gain, you have $15 million exemption plus capital gain you can use, for example, charitable trust, exactly, to avoid the capital gain tax. You probably don't have to pay any tax,
Right. So you
just distribute the profit.
You can set up a business.
Yeah.
You can set up a business so that it distributes income to you and you'll pay 37% tax on it. Or you can set up a business so that it rewards you in the form of growth, capital gains, and QSBS lets you eliminate tax on much of your capital gains. You can borrow against your stock. You can borrow against assets, and that creates tax-free income. So it's the difference between, are you trying to create income or are you trying to create wealth?
Yes.
And if you're trying to create wealth beyond a basic income, that's pretty easy to do. Oh, by the way, you can set up a C corporation and you can pay yourself through a parallel S corporation and still get the single taxation. But ever since the 2017 Tax Act, the double taxation isn't what it used to be anyway. So this is something that I see, and I imagine you see as well. People learn something and they keep it in their brain, and they never learn when it changes. So, a lot of CPAs say don't do CPAs, don't do C corporations because of the double taxation. Well, that's kind of out the window since 2017. I will still hear people say, I'm afraid to take a home office deduction because I think that's an IRS red flag. Well, the Supreme Court decision that got rid of the red flag was in 1994. So if your CPA tells you don't take a home office deduction because that's a red flag, your CPA is 31 years out of date, and respectfully, you need a new CPA.
Yeah. And a lot of time that I tell them, like, okay, double tax. Okay, if your base is zero, no matter how double or triple, you type zero, it's always zero. You make your C-Corp zero. You put all the money, you invest all the money in technology and developing the value. And not only, you don't pay double tax, but the federal government give you R&D tax credit. California, another 5%. Let the government pay 15% for your investment. And even beautiful is even if you have cash, instead of distributing to your shareholders, put it in there. This money, when you sell, it will multiply. These are, Apple put all these cash in their company and it make the company look good.
Sure.
When you sell it, it reflects on your stock price with the multipliers.
Right.
Much more money than distribute.
Yeah. I don't think Amazon has ever paid a dividend, has it? I know it went years and years and years without paying a dividend, but it's rolling everything back into becoming more valuable. And if Jeff Bezos wants a $500 million yacht, he can sell some of his stock and pay a 20% capital gain, or he can borrow against the stock and pay zero capital gain. And at his death, any stock that he passes to his heirs gets stepped up in basis, and that gain gets eliminated forever. Not just deferred, but eliminated.
Yeah, I always believe, entrepreneurs, what game are you playing, right? Are you playing an S-Corp game, making this income, or are you creating company, eventually you sell or IPO and then you make, millions, and that's called wealth and generational wealth.
Yeah, exactly. Are you looking for income? Are you looking for a high income? Are you looking for generational wealth? And it's possible to live a very nice lifestyle on the income that you can pull out of a growing business, but save the real payday for down the road. And that's the choice that a lot of entrepreneurs have made.
Yeah. And then I have an interesting story I will have to tell you. So, CPAs, some of our CPA colleagues were thinking so small. So I had a client came to me. He said, my CPA cannot do my tax return. Why? Because we have a $10 million capital gain, but I qualify for qualified small business stock, right? And
Okay.
he doesn't know how to do it. He has never had done it. I said, okay, I can help him. So I said, okay, what is it? It's capital gain, right? Okay, where does capital gain go? Okay, Schedule D. Okay, he said, I got that. Okay, let me show you our Schedule D. There's a checkbox, for Section 1202 qualified small business stock, and it's cute. Now on the form, it shows as a cute. So once you put $10 million there, and you check cute, it becomes zero.
Right. The taxable amount is zero.
So that's very, very simple.
Yeah,
said,
it doesn't require a big upfront planning fee. It just requires having started the business the right way and operated it the right way.
And he said, no, I dare not to do this. Like, if this is something wrong, that owes a lot of money. I can't dare. I dare not to take this.
Really? The client who qualified for 1202 treatment was afraid to take...
No, the CPA.
Oh, the CPA. Oh,
I haven't done this. And I don't want to do it.
So why is that?
Because
they're afraid.
He's afraid that if something wrong, and then there's a penalty and the interest, and then he has to take responsibility. And his liability coverage maybe it's like $100,000. So
right.
So
yeah. So when Neil, when a CPA signs a tax return, they are taking responsibility for the accuracy of the tax that they report. And if the CPA takes the 1202 exclusion and the client is not entitled to the 1202 exclusion, then the CPA is potentially on the hook for penalties as well. The IRS has a category called preparer penalties. Preparers are hardly ever penalized, but CPAs tend to be pretty risk averse. And someone who has never done something before, the same for all of us. When's the last time you did something really important for the very first time and you nailed it? People are reluctant to take responsibility for something like that on a return if they've never done it before. So the answer is let a CPA who is comfortable with this strategy prepare the return and sign the return. But don't tell the client, you can't do it. Be sure that you tell the client, I'm not comfortable doing it. That's a big difference. That is
Totally.
a big difference. And I hear people come to me, not infrequently, and they say, my CPA won't let me do this. Like, well, your CPA is not the boss of you. Your CPA is not the head of your family and the CEO of your company. If
Right.
the CPA won't let you do something, get a second opinion. There are 665,000 CPAs in this country right now. If we assume the average CPA is 5'8" and we lay them head to toe, they will stretch from Grand Central Station to the suburbs of Atlanta. So if your CPA won't let you do something, you can find another one. You can find another one. And if two of them disagree, bring in a third one and do some research. But too many people just don't, they don't go beyond their initial CPA's reaction. And it costs them a whole lot of money.
Yeah.
Seems
With that said, I really want to say, a CPA for me, I have a mission. I want to help entrepreneurs, and I'm in their shoes, and I have like the same frequency with them, same risk profile with them. So I tell them, okay, we should take a calculated risks, and this is how we think. So most people make decisions based on the worst scenario.
Yeah.
And I said, the real rational, intelligent person make decisions based on the most probable scenario.
Yes, the likeliest scenario. What's the expected value of an outcome? So there are two kinds of people in the world. One kind is presented with an opportunity and they ask themselves, what happens if this works out? The other type asks himself, what could go wrong? Now, we need both types of people in the world. If you're an engineer at NASA and you get numbers wrong, or if you're at SpaceX, the rocket's going to explode and the astronauts are going to die. Versus if you're an accountant and you get some numbers wrong, somebody doesn't get their money. It's not that big a deal. But you make a really good point, Jinhong, and let's talk about that, because most tax professionals are very risk averse. They're rule followers. They spend 4 years in college learning the rules. They get their first job out of college and they follow the rules. They are risk averse. Most entrepreneurs are very comfortable with risk. That is a key characteristic of being an entrepreneur. You are comfortable with no guarantee of success. So you have a mismatch. In so many cases, you have an entrepreneur who's comfortable with risk, a CPA who's not comfortable with risk, yet they've never had a conversation about where are we going to go. Entrepreneurs typically have a team of advisors. There might be a wealth manager who manages their portfolio. There's an insurance person. There's an estate planning attorney. There's a business planning attorney. And then there's the CPA. The CPA is the most conservative, most risk-averse person on that team. Then the entrepreneur hears the word tax, and he thinks, that's a tax question. I'm going to delegate that decision to my CPA. And they're unwittingly delegating the decision to the the one on their team who is least comfortable with risk. It's a mismatch, and it holds entrepreneurs back. It holds people back, and yet they don't realize it. So there are a couple of solutions. One is you ask everybody. You don't delegate a tax decision just to your CPA, because your attorney can weigh in on it. Maybe your financial advisor can weigh in on the tax consequences and how they affect your overall finances. So one way is you don't just delegate a decision to the CPA. The other way to handle it is simply to have a conversation up front with the CPA and find somebody who shares your comfort level with that particular risk.
Yeah.
And when it comes to the 1202, this is not a tricky tax strategy. This is simply the code section that says if you start your business as a C corporation and you operate it in these specific lines of business, then when it comes time to sell, at least 3 years down the road, part or all of your gain is going to be excluded from your income. You don't need to get an opinion letter from a fancy white shoe law firm saying that here's how Section 1202 works. You just report it. It's one line on Schedule D, and you put Q in the code, and you're done.
Yeah. And I have never had any client being audited for Section 1202, because one is the tax law, the intention of tax law is actually encouraging people to take advantage of these incentives. So it's good for society, right? And
Congress thinks it's good for society. Mm-hmm. The White House thinks it's good for society. So let's talk about that for a minute. The qualified small business stock has been attacked as a loophole. It's been attacked as a giveaway for rich people. Obviously, if you have a $10 million gain, you're doing pretty well in life and you're doing better than most people. Congress passed this rule back in 1997 at the beginning of the internet revolution, when these technology companies were just starting to get big, and some of them crashed. Pets.com, not around anymore, but you can still get pet food online. But in 1997, Congress passed this rule. They passed it so that Americans could take advantage of it. Then for nearly 28 years, this rule was in effect. Then in 2025, the big beautiful bill extended the rule. They said, hey, we haven't raised that $10 million threshold since 1997, so we're going to raise it to $15 million, and we're going to make it easier for some businesses to qualify. And oh, by the way, under the old rules, you have to wait 5 years to sell your stock. Now we're going to give you a partial exemption after 3 years. So this is the people in Washington, D.C. saying, we have made this strategy easier to use and more valuable. Washington wants you to do that. Now, you might be you might look at that and say, oh, that's not fair to poor people, that rich people are getting the tax break. But it is the law. It's what Congress wanted to happen. And Congress did it for a reason. It wanted to put money in the hands of entrepreneurs so that they can go out and hire more Americans. And small business creates the jobs. Amazon isn't creating jobs. Amazon is laying people off. Big businesses are laying people off.
IBM too.
They're going to get
Salesforce.
Yeah, all of them. Those jobs are going to be replaced by small businesses, the kind of businesses that benefit from Section 1202.
Yeah. Yeah. And, the bottom line is a risk, right? So I always tell people, first, there's no one home in IRS. What I mean is nobody's reading the tax return. It's just, right? So
it goes into a computer.
So the computer is basically checking data points. You have a 1099 and, you don't report that revenue, then they will issue a letter say you underreported $100,000 revenue and you owe us $30,000 tax. That's how it works.
Right.
However, there's no other reports, right? So, your whatever you report, that's the truth. That's a single point of truth, right?
Mm-hmm.
You make choices thinking this way. And then, of course, I tell my people, so some clients are like real estate agents, insurance people, they come to me and I look at the last year's tax return, like, whoa, they're paying, $100,000 self-employment tax, It's like, what the hell are you doing this? Let's do an S-Corp. And then
let's do an S-Corp. Let's get your self-employment tax. Let's get your employment tax bill down to 20 or 30,000.
But what happened is, my 1099 is in my personal name. And that's okay. I am going to report it in the S-Corp. And then, yes, you will receive a letter, but don't worry, and then they just give it to me. So they receive a letter, says, you owe us whatever amount, $100,000 of tax. I said, we reported a 1099 under the S-Corp. That's it. End of story. This is not like something, it's all computer generating letter. And then we responded. Like I had a client in 2020, I think, 2020, received a letter saying that, you owe us $100,000 tax. And I know immediately why. Because that year, Donald Trump says you can have 100% of AGI put into your foundation, charitable foundation, and you don't have to pay tax on that, right? You reduce. So the system calculated based on 60%.
Okay.
So I sent an email saying, I sent a letter saying, you're wrong, and and they corrected it. So we're dealing with the computer.
Right. Let's be fair. It's easier for us as professionals to see those letters cross a desk. If a client gets a letter from the IRS saying they owe $100,000, they are going to freak out.
Yeah.
They're not going to have a good time until they've gotten you on the phone on an emergency call and you have talked them off the ledge. But
and I usually tell them up front, it's like, this is what we're doing. And you may receive a letter and just send it to me. I will respond to them, right? Mm-hmm. So it's one of the things I'm doing with some clients, and it's I don't have experience, but I feel logically it works, right? So we create a private foundation and then donate the money in there. We had the charitable deduction, and then we buy life insurance as a key life insurance. For me, logically, as long as you have the death benefit, the beneficiary, as the foundation, then it meets the criteria, right? With logic, right? Mm-hmm. So, and I tell clients, like, I'm pretty confident that based on what I learned about the insurance, what I learned about tax, 99.99%.
Yeah.
Go by, and most likely you never receive any letter. But if you receive a letter, tell me.
If you do receive a letter, come to me. Nothing is 100% guaranteed.
Yeah.
Most of the tax strategies that I use are pretty much 100% guaranteed. For example, I'm looking at buying an airplane for myself at the end of the year as a tax shelter. I'll buy the airplane, I'll lease it to a flight school, I will make a small down payment out of pocket, and I will deduct the entire price of the airplane, and that will offset the tax in a greater amount than the down payment. So that'll put cash in my pocket. Now, that's code section 168K. That's bonus depreciation. That's black and white letter law. I will have to materially participate in my leasing business. I'm going to travel to Florida. I'm going to see the airplane. I'm going to inspect it. I'm going to meet with the flight school. I'm going to meet those requirements. So if I meet those requirements and I can document those requirements, then I have no doubt whatsoever that my deduction will be legitimate and will be accepted. There are some strategies where there is some doubt, and at that point, people can make their own decision. Clients can make their own decision. It's hard to quantify, okay, what's my risk of being audited? There's one strategy that I like using with business owners. There's about a 15% chance of audit at this strategy level, not the personal level. But work with the right vendor and you're not going to have a problem with the audit. That's a risk exposure. Some people are comfortable with it, some people are not. It's just like in investing. I mean, Neil, you've had people on, you talk about all sorts of topics here. You've had people on your show where you've talked about Bitcoin. And there are a ton of people in this world who would never touch Bitcoin. They just don't feel comfortable with it. That's fine.
Too much risk.
That's fine. There's too much risk. There are plenty of other places. I mean, I've said this to you before. The only thing I know about crypto is you can't spell crypto without cry.
I mean, interesting, and you're right. I was going to say that, but you could say on paper it looks like the best deal in the world, and then bam, we have a catastrophe, and then everyone's lost their money. So
right, and some people just aren't comfortable with that risk. I had a call earlier today with an entrepreneur. We were talking about a equipment strategy that involved a personal guarantee. And he said, I don't feel comfortable with a personal guarantee. It's one thing to personally guarantee a loan for a business that I'm running myself. But if I'm personally guaranteeing a loan to participate in an investment where I'm not controlling it, I don't feel comfortable. I said, terrific. That's really helpful context. Here's a variation on the same theme that does not require a personal guarantee. So this is, I think, an underappreciated aspect of what Jinhong and I do as tax planners. In a lot of cases, we're assessing our client's comfort with risk, and we are matching the risk with the program. So somebody says, okay, 99% chance I'm going to be fine on this strategy. That's great. 70% chance I'm going to be fine on the strategy. More people will say no. Some people will still say yes. It's different strokes for different folks, and that's why there is no single playbook that I can hand every client and say, this is your tax plan. I've got to match the strategies to their goals. I've got to match the strategies to their risk tolerance. But ultimately, I'm doing the same thing that Jinhong is. We are helping entrepreneurs. We are helping high-income individuals make the most of their opportunity in a country that rewards success. You can certainly argue that it rewards success unfairly, and that certain people are privileged and are likelier to have that success. Those criticisms are absolutely legitimate, but it is a country that rewards success.
So I really love your example about the lease of airplane, right? And that with that, I want to say the first principle of tax planning is your story.
Yes,
it's not a story. It's like for example, I have clients who are making good money with W-2, and I say, okay, let's get a rental property, and how do we do it in the way that it qualifies an active income?
Which exactly, yes.
For real estate. And so the way I do it is like, okay, first let's do it as a short term. That story sounds better. It requires more active, to Airbnb.
Right. If it's a short-term rental, we don't have the same limit in place.
Yeah.
We have more flexibility.
And then secondary, okay, I'm going to start with LLC, and there's this property management company, we're going to manage it as an LLC, not put it on the Schedule E, right?
Right.
Put it on Schedule E, you're also subject to the $25,000 limit. Now it's a business, okay? It's going to be a K1. And it's also more formal, right? You are, even it's just one property, but you are positioning yourself as a property manager, an investor, and you have a company to do it.
Right. Yeah.
So that story sounds so much more. And if there's an audit, okay, all of these things that we have.
If you get audited, then at the audit, you show the IRS that you have followed the rules, you've dotted the I's, you've crossed the T's, and you're doing it in a way that qualifies for the deduction. I can't tell you how many business owners come to me and they say, I've got my business and I'm running my business and it's profitable, and I'm also investing in real estate to generate tax advantages, to generate tax losses from non-cash depreciation deductions. And then I look at their return and I see that they're not actually able to deduct those losses because of the passive loss rules. And I will show them Form 8582, and I will say, this is the amount that you're not getting to deduct this year. You have to carry it forward. Would you like me to show you how I can help you restructure your business so that you can take these losses? And we'll peel off part of their business and do a passive loss rescue strategy, and problem solved.
Yeah, and this is actually now, it's a huge. You can do cost segregation and the bonus segregation, and I tell people what, you buy a $500,000 property, you put a $100,000 down payment. You may end it up with a $200,000,
deduction.
And that's, you get a $100,000 tax saving. It's like you didn't pay any fee.
Right.
And you have a house.
Right. You're leveraging the tax advantages, and now you own a house that you wouldn't have owned.
Yeah. These are amazing strategies. So,
and Congress wants us to do this. They want us to build more houses because when you build houses, you spend money and people get jobs.
Yeah. Right. And I really love what you did at demystifying IRS, right? And I'm doing seminar now. It's I added my own twist. It's like transforming IRS from a perceived enemy to your wealth creation partner.
Oh, okay. I like that. Yes. So I did the demystifying the IRS presentation, I think about 3 weeks ago on this show, but I'm glad that you have taken it a step further.
Yeah. And it's the mindset. Most people are stuck in fear.
Totally.
Yeah, and even people say, okay, if I pay IRS little tax, then am I more likely to be audited? I say IRS is not a human being. It's not like emotion thinking.
Right.
With the system, you have to play this game, right? That's how this is the system. It's just a computer.
Right.
Data. Yeah.
All right. It is crazy, but we can understand the craziness and we can take advantage of the craziness. And we're not breaking any rules because we're doing what Congress encouraged us to do. So I want to wrap up the show by answering a question that I sometimes get. And that question is, Ed, what happens if we get rid of the income tax, or if we go to a flat tax or something like that? Are you worried that you're going to be out of business if this happens? And my answer is no. I don't worry for a second, because I know that the tax system is not just about raising revenue for the government. The tax system is about managing and manipulating our behavior using financial incentives. So why do we have a mortgage interest deduction in the United States? Because Washington wants us to own homes. Washington wants us to buy homes, hold homes, renovate homes, and when we sell, buy another house. Why does Congress offer advantages to rental property and let apartment owners and rental house owners depreciate property? Well, because they know that for those of us who don't want to own a home or can't afford to own a home, we still need a place to live too. So Congress uses the tax code to do so much more than just raise revenue. I don't see Congress ever making the decision that we're going to give up the power to manipulate people through the tax code in order to simplify things. And we talk about tax simplification, but the big beautiful bill this summer made taxes more complicated. Every time we have a new tax bill, it makes things more complicated. Yet for you guys watching Lion's Share, complexity is what creates opportunity. So Jinhong, thanks for joining us. I appreciate your availability this afternoon. And Neil, if you want to wrap it up for us.
Absolutely. Jinhong, where can we find information on you?
My website is hzcpas.com. You can go there and just click schedule time with me. Or, easier to remember, timewithjinhong.com. So Jinhong is Jinhong.
All right.
Timewithjinhong.com. I like that.
Yeah. And or you can text me. My number is 949-397-0189.
All right. Fantastic. And Ed, best place we can go is your website. And that is?
Go to my website at edwardalyon.com and like and follow this podcast.
Yes. Like, share, subscribe. And I'm telling you, you're not going to hear such different type of conversation regarding building wealth, except with Ed. I appreciate it, Ed. Thanks again, man.
Thanks so much.
All right. That was a special simulcast Neil Haley Show on the Lion's Share podcast.